This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are very pleased to welcome on Steven Hamner and Alex Boshart with Parellel Lending, the two founders of the company. And we're going to be very interested to dive into a topic at hand that, I feel like gets a lot of people look at saying, hey, what did the pre-COVID world look like versus the post-COVID world, and especially now what we're moving into in the current markets, especially in real estate. But more specifically, we're going to be focusing on lending. Real estate is many things, but cheap it is not. So most of the time, the counterparty to any type of real estate transaction, besides just the buyer and seller, is going to be someone applying financing to that deal. Whether that be owner financing or a firm such as Parellel Lending, or somewhere in that stack of your investment, there's going to be the money man. Right. And that landscape has changed drastically between what we saw in, 17, 18, 19 leading into 2020. And then, going forward from there, we saw basically just, lighting the candle and watching it burn down when it came to interest rates and the velocity of money, just again, continuing to draw that down. And then really seeing a paradoxical shift in our monetary policy to start continuing to raise those interest rates to combat inflation. Whether or not that was actually successful, I'll let the listeners decide on that. But again, it does definitely dynamically change the marketplace when it comes to lending and how those different kind of things are addressed when it comes to, buying and selling real estate, which is what a large portion of our listening audience is invested in, is real estate. So with that said, I'll turn it over to Steven and Eric. If you wouldn't mind, give us a little bit of background about each of you and kind of how you came to found your company and what your investment ethos was and kind of how you addressed these different buckets of the past several years.
Eric, you want to kick us off?
Yeah, I'll go ahead and kick us off. I was about to throw you the pitch, but you threw it right back to me. So, but yeah, I think I'll just start from 2017. That's when I started getting into real estate investing. 2016, actually 2017, and we just started with flips. We did a flip on accident. We moved into a small little house, me and my wife, and we added a bathroom. And all of a sudden, it was worth $100,000 more. And so they were like, "Oh wow, there's something to this." And then so we started flipping more and more. We started just living in our flips. Essentially, we just did live-in flips for our first 3 or 4 flips, and we actually moved to Florida. Alex, we were talking off air, and we just flipped a few beach houses. And so once we started doing it ourselves, we saw there was some actual revenue potential in this. So we started to get a crew and started doing a little bit more. Got into some rentals, and over the past few years was able to do okay. And how we started Parellel and how we started this lending company is Eric's brother Alex is one of my closest friend, and they're also into real estate. I'll let Eric kind of share their story once he takes it. But we all started to figure out we're doing okay. We've all used private lenders in the past, and we'll get into the pre-2020. I know down the road, but we were all using lenders for our own investments and flips, and we were able to build up this little pile of cash per se. We're like, why don't we just kind of start this ourselves? We know the ins and outs. We've been doing this for a while. I say 5 or 6 years before we started doing this, but we've been doing it for a little bit. We've had some success, so we understand the business. Let's go ahead and start this going. And so that's how we started Parellel. That's how we started the lending business, is by having a lot of experience ourselves as investors, by looking for other ways to get capital to work for us, and just understanding the lending kind of landscape, if you will. And that's how we kind of got started with it. Me and my wife started living in our own flips. Then we started doing rentals, and then we kind of just grew. We had capital. We had some capital and some cash to use for other ventures, and then we kind of dove into lending. So Eric is my best friend's brother, and in doing that, we've become super close friends. So it's always fun to work together with people that you love.
Yeah, absolutely. I mean, I would say, we get a lot of advice of don't work with family, don't work with friends, because things get hairy, and that has not been the case with us whatsoever. We're always of the mindset of do business with people that you like, that you get along with, that you trust, and so that's really how this whole thing started. I'm a real estate investor and real estate lender with 2 arts degrees. I have a master's of fine arts in film, and I thought that was going to be kind of my life when I started. I acted a little bit in high school and in college. I directed a few short films. I wrote some scripts, and I thought, man, I'm going to be the next Spielberg. I'm going to be this great hyphenated artist. So I went out to LA, got my graduate degree, and started working in film. And then I just kind of stumbled my way into the financing part of Hollywood, which is totally different. It is this blend of creative and very technical and very there's obviously a very kind of mature kind of financial market as it relates to Hollywood. So I kind of got into more of the independent film world and selling the distribution rights to films. And then I transitioned to actually investing in films more on the credit side. So we would lend out money against tax credit receivables. We would lend out money against distribution contracts. And from there, I kind of honed my modeling skills, my finance skills, my negotiation skills, working at a private equity shop that dealt with filmmakers primarily as our borrowers. It wasn't the easiest job. So that was a great kind of, great experience for me, but realized that, filmmakers weren't the best borrowers. They got into the business to, tell their story, not necessarily to negotiate, credit contracts. So when my brother started investing in real estate more heavily in the DFW Metroplex, I decided to move to Texas, be with him, start flipping some homes. So we did that all across Fort Worth mainly, got some in Dallas. And then, really the writing was on the wall for us, in terms of, where do we want to take our business? Where do we see the market? This was pre-COVID, and we thought, okay, we definitely want to lend out money, using my private credit experience, using our experiences as real estate investors. It just took us a little while to get there. And then we, Steven and Alex, I think were speaking and thought, hey, now's the right time. Steven was our first investor, and became a founder through that route. And it really just kind of took off from there. And so, yeah, again, us having that real estate investor experience before, before getting into the kind of hard money lending space was important for our borrowers, at least our initial borrowers, because I think a lot of these shops that set up a private lending business really come from the finance world, and have never flipped a home themselves or never invested in real estate themselves. And I think that was, you can tell that when you're talking to, the account executives at one of these bigger lending firms that might be on either side of the country. You can tell if they've actually been inside a home and renovated before. So that was important to our borrowers, and I think that's a big contributor to our success, which we can get into in a little bit more. To answer your question about ethos, investment philosophy, I think that's kind of, hitting the nail on the head, so to speak, in us deciding, if we're going to get into the lending business, we want to make sure that we approach it as if we were the borrower. And I think largely the hard money lending industry is saturated. I think there's, probably about 200 active lenders just here in the DFW Metroplex. And they all kind of offer the same terms, similar process, similar advertising at least. It's, no credit check, no background check, no appraisal, up to 100% financing, starting at, anywhere between 7 and 10% interest, 2 points. We can close in 48 hours. That's, if you Google hard money lending, that's what you're going to see. And so we thought, how can we differentiate ourselves? How can we make sure that we're, serving our borrowers the best? And it's really taking that qualitative approach. And I don't know how scalable this is in the long term, but taking that qualitative approach and saying, okay, let's interview you. Here's my cell number. You can text me anytime you want. Let's do a site visit together, and you can walk me through the home and tell me about what your vision is for the home. Why are you getting into real estate in the first place? Why are you flipping this home? Is it to make a bunch of money? Is it to stash some away for your your 2-year-old for their college fund? Is it to get out of your W-2? The reason why we called it Parallel, and Steven came up with this name, is we are running parallel to our borrowers' goals, and on their path to financial freedom. So that was really important for us to make sure that we be borrower centric, because it's a really saturated and mature industry. And I think a lot of hard money lenders got in this space in 2007, 2008, during Dodd-Frank, and the ruins of the global financial crisis. And hard money lenders could charge 18% in 5 points, and it was okay. No one was blinking an eye because there was no one else lending on real estate. They didn't have to be customer friendly. They didn't have to close in a short time period. They can charge, borderline usurious rates, and it didn't really matter. And I think a lot of those hard money lenders that came out of 07, 08 are still operating in that fashion, and they're losing business. So if we can come in and say, we're going to be borrower centric, we're going to take a qualitative approach to our underwriting in addition to the quantitative, I think we're going to be really successful. And so far that's proven to be the case.
Yeah, nice. It's always good to kind of understand, to build the pyramid from the base up of understanding where people are coming from. And to your point about the film financing, that's an area that I've always found pretty interesting. I interviewed Mark Miller from the Hilton Wealth Family Office that does a lot of film financing, and it was fascinating to kind of dig into how that stuff works. In my career in dealing with alternative assets and retirement plans, I've probably had a hand in almost $500 million worth of, real estate financing just, come across my desk when I was doing investments. So to see something that's, in all forms and flavors, like getting to see how that market has matured and changed from, I started my career back in the early part of 2012. So to see how, what was rising from the ashes of the GFC and going into, new markets, and then through COVID, and, now what had 3 different administrations. It's been really interesting. So, from the point, let's kind of start, what is kind of like when, previous to COVID, when did actually parallel lending get its start? When did y'all kind of like really hit it with, getting into the market? Was it like 16, 17? When was kind of the genesis?
Yeah, we did our first loan in 2019, and we really weren't all that active. We were just trying to get our toes, kind of in the water, so to speak. We were still actively flipping and we still do that. But it really kind of started there. We did one loan out of, for just friends and family investment. I don't even think Parallel wasn't even an entity at that time. We just put out a loan to someone in Pennsylvania that was a friend of a friend, and this was kind of like our first market research, let's call it. And during that time, just to talk about kind of the pre-COVID world, and we can talk about the during COVID world, which I think is definitely an interesting topic. But pre-COVID was sort of a race to the bottom. And I think this is why it took us so long to really start building our business, because we saw where the industry was going because of the zero rate environment. And so when you have a credit line at 4% with a bank, and you can lend that out at 7% and still make good money. When asset prices are rising, no matter what, you throw a rock at a home and it's appreciates $50,000 in value. It doesn't matter. It doesn't matter, what leverage you're putting on that home, because if the home is going to be flipped within 6 months and it's going to go up 10% in 6 months, then you're okay. You're covered, even if you're doing 100% financing. And so we saw that, and while that's a great market for sellers, it's a great market for lenders too. You don't have to worry as much. It clearly wasn't sustainable. And then you get it, and then we can get into COVID, which was totally different, and more of totally different, but not different at the same time, because it was completely an acceleration of what was already happening. The rates were kept, incredibly low. We were seeing over 100% financing, which is crazy. And that's something that you saw in, in the lead up to the GFC with banks, with the ninja loans. We were seeing it in the hard money lending space. And so it was like, let's just wait until this changes, which was 2022. And everything changed. So maybe I'm getting ahead of myself a little bit, but that's
a touch, but yes, it's definitely kind of an interesting point that you bring out is, that trajectory of the race to the bottom. It's when I bought the house I'm currently living in back in 2016, it's, like you're getting, it's like, oh, great, I'm super happy with, 3.75, on a single family. And, how does that really kind of lead to a healthy flipping market? Well, you have, people, again, that can come in and basically, again, to your point of almost being able to charge you usurious rates, that really didn't change too much. I mean, granted, there's going to be a cap to what people are willing to pay. You can't be like, yeah, we're paying 50% interest and don't tell the state. But, there was an abundance of lenders, there's abundance of money, and the velocity of it was just absolutely wild. And we really haven't kind of seen a throttling of that until, the past 2 years. But to kind of get to the point I'm trying to make is that, you have such a, whether it's good or bad that it was robust, it was robust, where you have kind of that built-in, equity appreciation, 24 hours after close. You buy something and then the market's, 45-degree angle going up on that chart, which is, hard to sustain. And especially it's like, how do you position yourself when money is so cheap? So you're coming into it, and it sounds like you're kind of tooling up and kind of getting and it's kind of a bad time to kind of be getting your your feet under you right before COVID happens. Maybe to a point though. So you're kind of getting into this and seeing, okay, well, we can kind of charge what we want to because people are, again, just not really caring so much what the cost of the money is, because the velocity of the assets is, real estate, traditionally it's not very liquid, but it almost was to the point where it was a liquid asset. You have stuff where it's like it goes on the MLS, and if you don't have a contract in 24 hours, like, were there not pictures of it? Did you forget to upload the description? It's like, was the house literally torn off its foundation by a tornado overnight? Otherwise, this stuff was moving at just a mind-boggling pace. And this, from what I was seeing on our client-facing side, I was super happy for my clients, but it just made me scratch my head going, well, how is this sustainable? So again, you're kind of getting your feet underneath of you. You see this market where, you get to basically, there is no negotiation on terms. You get to say, okay, here's what it is, and then someone will come along and take it. So, let's kind of lead into that 2019. You kind of got your first few loans done. Leading into, kind of March, April of 2020, what were some things that you were positioning to do that fundamentally changed after that kind of marker in time?
It's a great question. I'll let Steven answer this one as well, but we kind of took a pause on the lending and started, and we're flipping homes and investing in real estate ourselves because nothing made sense. It really was a market where it made so much more sense to be the investor when prices are skyrocketing. And obviously, March of 2020 was a terrible month. But then after that, for the next 2 years, it was gangbusters. So we kind of built up our cash position. We sold rentals, we sold flips, and we started positioning ourselves to be ready for when things were inevitably going to change. I think both Steven and Alex and I knew that inflation was not a transitory thing. We knew that the market wasn't sustainable, regardless of supply and demand. Just like the general principles that we adhere to. No matter net migratory patterns being positive to Texas, people getting out of these these places with really stringent COVID policies. It just, nothing made sense in this topsy-turvy world, and so we started liquidating our positions to gear up to start lending in a really aggressive way. which we really didn't start doing until, and I mean in a scalable, started like really actively doing a lot of loans until those interest rates spiked suddenly and totally unexpectedly. And we finally said, okay, this is the point. Like this, we finally see that the economy is doing what it should have been doing probably, in the later part of 2021. We're finally seeing this this major event happen that we needed to see in order for us to feel more comfortable with gearing up our lending.
Yeah, I think to piggyback on what Eric said, like, to be honest, it really didn't change at all for what we were doing at the time. We kept flipping. We had rentals. I was just trying to, because I was like, man, how long is this like great market for sellers going to last? So like when I would get a new property, I was like, can we just get on the market real quick? Like it doesn't have to be top dollar. It doesn't have to be what we usually do per se. I was just worried like, hey, at some point this is going to stop. So can we sell it real quick? It took a few years to stop. And we were in the Florida market, and we had some duplexes in St. Pete, Clearwater area, as you know, that area, Alex. And so it was just like, it just kept going up. It was wild. And then in Austin at the time too, that was like the perfect time to be flipping. Now it's a bit high, but at that time, like it just kept going up. And so, like I didn't even think about lending at that time. It was just like, man, we have all these properties that we have. We have a huge spread for what can happen. Like one of our worst properties we've ever gotten, as far as like headaches and stress and tenants and putting money in, was our most like financially successful property because of how much the market was appreciating, because of just how little we got it for at the time. So during the COVID time, it really didn't stop anything for us. We just kind of kept going. Maybe because I was, young and dumb and was just like, I don't know what's going on. I'm just going to keep doing what I'm doing. But definitely worked out, and it definitely did change. Then we started to see some things dropping at a certain point. But during that time, it was just investing, real estate investing. We sold, I think, all our rentals at the time. We sold every property we had in Florida. We moved to Texas, and so we were able to get a good pile of cash during that time period.
Yeah, so kind of what I'm hearing though is that you kind of took your initial plan of being lenders and transitioned to saying, okay, well, the Fed's, Powell's going to continue to sit here and then slash things with a machete until, so it's like, what's the point in kind of trying to compete with, again, like a 2% 30-year fix? Like how much more, again, people are fine with paying stuff, but when you have institutional lenders lending out at, basically free. I didn't understand how that was reasonably just a thing. It's like where is someone making a spread on this? Even if you're holding it for 30 years, you're doing 30 years to capture 2.25.
Right.
What's going on? So basically you said, okay, let's transition into taking advantage of the equity play here. Let's buy some property. Let's go through that. And again, I'm assuming that probably played pretty well for you for that time being, but when was kind of the, inflection point to say, okay, look, we're doing this, it's working out well. You reposition from Florida out to Texas, which, again, I don't blame you. Just the insurance out here is the big killer. There's still plenty of, you can still pencil everything on the deal in Florida right now, except the insurance is just impossible. We have lenders backing out left and right, we have insurers backing out left and right. So, underwriting the insurance on a property is really where it's killing us here. And parts of Texas, I'm assuming, especially after this hurricane in Houston, are going to get a little dicey. But again, so you have this kind of transitionary period where you say, okay, let's start buying property. At what point was that inflection that happened to say, okay, look, here's kind of the market, here's where the market is going, and we should transition back into lending? Was it when the Fed started, when Powell started saying, okay, let's turn up the heat on interest rates back in, the beginning of 23, or was it, closer into 22 when you said, look, let's get back into the debt side, let's stop playing around with the buy side, or is it still kind of a mix of both?
Yeah, it's a great question. I think it was for us the second half of 2022 where we said, this is our moment. These things don't last forever. This is our time to really start aggressively pushing into, when we started seeing those signals. I think Alex and I sold a good portion of our portfolio in the first half of 2022. We might look like oracles. We just got really lucky there and kind of timing the market. And to be honest, things are still going up. So we can talk much more about that and in kind of the post-COVID world and how it's still a little topsy-turvy. But yeah, it was really the second half of 2022. You look at kind of the you look at historically, what's happened to countries when the central bank raises their federal funds rate. It's really there's a lot of predictability, even globally, no matter whether it's the Bank of Japan, whether it's ECB, or what's going on in South America. You just see when things happen sharply and in a very short time period, you feel very acute pain, or you feel very acute correction or stabilization, whatever you want to call it. It just depends on what side of the transaction you're on. If you're a buyer, it's fine, because that means asset prices are going to remain flat or maybe even correct, and that's really good for your buying power. If inflation goes down, that's good for your buying power. So it just depends on what side of the transaction you're on, whether it's painful or a good thing. So it's something that's important to denote, is that people always talk about, oh my gosh, the interest rates are so high, it's so bad, and it's like, well, actually like 5.25, it isn't all that bad. It's actually pretty normal historically. And again, if prices are going up at 3 to 5% as opposed to 15 to 20%, and there aren't 15 to 20 offers for every house that goes on the market, if you need to relocate and you need to buy a home, this is a really great time. So it's always good just to put it in perspective. But yeah, we saw the writing on the wall and started really kind of aggressively lending more in the second half of 2022, and asset prices were stable. We were able to charge more, and then we were seeing other lenders cut back, and that's a really interesting topic that I love to talk about, and kind of extrapolate on, because that's something that we're seeing left and right, especially in post-COVID. This kind of signals of distress in our industry that are really interesting. And we went to the AAPL American Association of Private Lenders conference in Vegas last year, and that was the theme. The theme was survive until 25. And I'm getting a little bit ahead of myself in the post-COVID world, but I think that's a really interesting, really interesting point we should talk about.
Yeah, and to that point as well, it's the health of a market, I think, does kind of, again, float around the 5 to 6% rate. Again, to that point about, I still don't understand necessarily with the rise in, with what they're doing with monetary policy, we still are seeing price appreciation. We're seeing gradually more inventory stay on the market for longer, but we're still continuing to, it's kind of breaking that, supply demand of traditional economics, which again, it's starting to get a little bit more in line with, what you would expect to see. But, again, coming out of a world where, to use a personal example, people were able to, and I did it during COVID in 2022. I was able to refi my personal home and knock off 4 years of my mortgage and keep my monthly payment the same. What? How is that? How explain to me in a economic marketplace where people are actually still affording to put food on the table from the bank side of things, how it was mind-boggling. I start talking with my lender. I'm like, I don't think things can get much lower, and I'm just looking at it and I'm like, well, let's try to do this. How much more, how what else do I need to do to make this loan work? Oh yeah, X, Y, and Z. I came out I don't know, 4 or 5 grand in closing costs, and I knocked 4 years off my loan. I'm like, that's just bonkers. How? Explain this. It's like get one free, get another one free. I'm like, okay. Anyways, so I digress. It's, again, coming into a more traditionally healthy market, and to that point, it's okay. So we have a little bit more health in the market as far as the lending perspective goes. I would imagine the rise in rates probably really helps coming from where we were at helps the private lending market quite a bit. When you are now competing with, 5 and 7, you can charge, again, basically a living wage for your underwriting. And especially with, again, people always talk about in this market, and I'm not sure how much truth is there. It's like, oh, we're going to see this correction. We're going to see a pullback. I'm like, well, you can say that, but you're underwriting your deals first and foremost today. You need to have, a trajectory of saying, hey, where are these going to go, and the ability to pay, and what's the person's exit. Going back into, your experience in this, like having real estate investors that understand where these things go is very important. When you're talking to BlackRock, they're like, okay, cool. Well, your credit's good and this looks okay, and we're going to give you a draw loan of X, and don't understand the mechanics of it. Underwriting a deal in this area definitely lends to the experience that y'all have. So I guess kind of my next question would be, from the, 2022 perspective, you start getting back into things, you reposition, which, hats off to you for making that, that call when you did. But, we start seeing, again, what was it, February of 23 is when Jerome started kind of the monthly rate increases, I think, was right around that time period. So let's talk about like how that, like you underwrite a deal today, you don't know how many rate increases are going to be, but how do you kind of navigate that market with going back into being a lender when interest rates, again, we see price appreciation like this, but then you also see interest rates kind of, starting to match that curve on your charting. So how does that look for trying to underwrite deals? And did you have any like issues with the borrowers saying, okay, well, trying to get them to transition from this opinion of like, hey, money should be free. It's like, no, money's not free. You still need it. So what was kind of the opportunity that you saw, and how'd you capitalize on it during that time?
Yeah, I'll answer briefly on that. The spike in the federal funds rate was good for us because we weren't all that active when we were in a zero rate environment. It was bad for the active lenders who were at the race to the bottom. So for the active hard money lenders that were, really going crazy with origination and underwriting over the course of 2020 and 2021, they were providing 100% financing or 105% financing. They were charging 7 and 1, no credit check, no appraisal, no background check. Appraisals didn't matter. They're just opinions of value, and no one was able to reasonably pinpoint what the price of a home would be in 6 months during COVID. So appraisals weren't even all that useful, and I'm saying this with an appraisal license. And so all of those lenders who were offering such aggressive terms because houses were appreciating at such a rapid pace, when the federal funds rate increased, their bank lines increased as well. If their bank line is tied to prime or SOFR +1 or 4.5 respectively, they had a 4 or 5% line of credit, and they were lending at 7, and now their line of credit is suddenly 9.5 or 10, and they're still lending out at 7. So they're losing money on each transaction, and so loans that they originated in 2020 or 2021 or even 2022 in their 12-month terms, and now they're due in 2023, and the environment is totally different. A large portion of our competitors' business was in workout mode because they didn't expect the environment to change so rapidly. And so what happened was a lot of these lenders kind of said, okay, hold on, we got to sit down. We got to work on these loans. Let's scale back our origination. Our overhead just went crazy because we have to service our debt now with these warehouse lines or these credit facilities with banks. The capital markets are just totally frozen up. We can't sell our loans as readily as we like. We need to stop originating, take a look at our portfolio, and reposition. We didn't have to do that because we didn't really have a portfolio of loans. So it was really good for us, and I think that's where we just saw a lot of opportunities. Our competitors pulling back, and us being able to say, "Hey, we're not pulling back. We're still actively lending. In fact, we're more aggressive than ever because we can now underwrite reasonably, and we can look into the future and say, okay, rates are going to be like this, hovering between, let's call it 4 and 6 on the federal fund side for the foreseeable future, and this is the new normal, we can adjust and adapt to that more readily than other lenders because we don't have a whole portfolio of loans that we need to reposition.
Sure. And from that perspective, I mean, again, the typical avatar for the lender or for the borrower in this case, are these all typically fix and flips? Are they more long-term holds? What are some of kind of the minutia of what you put in there? Is it, are these, interest only 5 years with a balloon? Again, kind of what's the general kind of underwriting, or do you kind of, because a lot of the private lenders I know that have been doing it for a really long time are a little rigid with what they like to do. They're like, all right, we do 4 with a balloon, 2.5 points up front and 8 to 10%. Like they have their thing that they do. And again, they still manage to keep the lights on their house. So, I mean, I guess it works. But again, being of a different generation than some of the other people that I know in the space, I think flexibility and dynamic ability to shift and change is the world that we're going to live in until I'm retiring. I don't think that kind of dynamic market thought and what's the word I'm looking for, environment is really going to change. So kind of again, maybe kind of dig into a little bit of kind of how you like to underwrite in this kind of dynamic market.
Steven, you want to take that one?
Yeah. Typically, our borrowers are fix and flippers, people just like me and Eric and Alex, how we started off. They were going to be fix and flippers or small builders with taking ground up construction. So that's kind of what we know right now. And that's kind of like our lane, what we stay in. So typically our loan will be, 12 months. And then if they need an extension, then we talk about it then. But typically it's the life of the loan is 12 months. I think they get paid off like average, Eric may know this, but like 6-ish months. I think it was a little lower. Now we have more ground up construction. So the average that the loans actually out is about 6-ish months or so. So those are typically like who we lend out to. It's just like who lending out to us essentially, which I think makes it a bit more natural and organic. Like right now we're just starting to flirt with some like marketing ideas. We've never done any marketing or anything. We've always had plenty of deal flow come in, great deals, but right now, we're in the process of raising enough capital to serve those deals. And so I think a large part of that is just the fact that we're in the same ballpark and circles as all these real estate investors. So we haven't explored anything past like single families and people just flipping houses or wanting to refinance it out in a certain amount of time. We haven't explored anything past that. We just kind of stayed in our lane. Not to say that we won't in 2, 3, 4 years, or whatever it may be. But right now, this is what we lend on. We have a small fund that we started recently that has us not dictated per se, but has us in the direction of lending to those type of borrowers. If that answer makes some sense. Yeah.
So you're really kind of in the the most traditional sense of hard money then. So you're really doing like 12, 18 months maybe max, like interest only, points up front, and a balloon payment kind of deals.
That's exactly right.
Exactly right. Yep.
Gotcha. So from that perspective, you said is it a transition to the ground up construction, or is it something that is what you kind of initially focused on? Because that's again a big difference between your end user and your borrower is kind of the people that are doing either the fix and flip or the ground up construction. So was that a shift, or was that who you kind of focused on when you came back into lending?
Yeah, we focused on, we're not builders. So we really focused on fix and flip in the beginning, and then we just kind of saw where the market was going, especially in the DFW Metroplex. We have a huge housing supply shortage, and so the building starts were down during COVID, and now they're up post COVID in a really meaningful way. And so I think 14%, 15% of our total portfolio is ground up construction. I assume that's going to uptick. A lot of flippers are getting into ground up construction, and so that there's a little bit difference in underwriting. We got to make sure that they use a builder that's been doing it a lot, and they're actually on the LLC, and we can use their experience and stuff like that. But yeah, we and through that we're actually learning a lot about building as well. But you got to get someone with a lot of experience, and really there's no market right now that's seen a downtick. So In the DFW Metroplex, I mean. So it's either remained flat or just steadily rising. And there's some places in the DFW Metroplex that are still going gangbusters, even in South Dallas. So we do have new builds. I expect we'll see probably about 30 to 40% of our portfolio over the next couple of years be ground up construction. We work with really active builders who do 10 or 11 at a time. So and we love to do as many loans as we can with them, not to be too concentrated with one borrower, but they are really good at what they do. And so we want to keep working with them. So I imagine that'll dictate our portfolio moving forward.
Yeah, from the perspective of your market, and at least in Dallas, so housing shortages drive new development, but do you see enough of a marketplace? I mean, certainly you do, but maybe kind of talk to again a little bit more of that avatar of what's going on. At least it's always interesting to look at specific markets, but a lot of development, in places like Arizona and parts of Florida, your DR Hortons that come in and just have institutional floor plans for their development. That's where you see the big tranches of new development coming. So is there still a robust market? And maybe if outside of your, again, kind of your location, is there still a good market for the individual that's doing like, they buy a couple lots and put houses on, or they just raise down a few and then do ground up construction from there? Where are these people kind of focusing? That's again different from your DRs that are coming in and just doing these blanket communities.
Yeah, so we'll see DR primarily in kind of the surrounding areas, even outside of the suburbs of the city of Dallas proper, places like Kaufman or Forney or Terrell. These are that's all east. You're seeing in Grand Prairie, even like way further south, like Midlothian. These are more kind of tertiary markets, and a lot of people are. It's like in the path of progress. A lot of people are moving there because they're getting priced out of Dallas. But you're still seeing these kind of infills where our smaller builders can go in and build one house or two houses and really customize them and make them really kind of luxurious for the market. So we're seeing that in South Dallas in 75215. We're seeing that in Cedar Park. We're seeing that in Trinity Groves. These are all kind of closer to the city center. And yeah, there's either an old home that's beyond the state of repair, or they're just build ready lots where you can build something really custom and unique. That way you can get a solid end buyer.
Yeah, no, it definitely makes sense because I'm always interested in that kind of perspective, especially for people that work in the ground up in the single family. Because I talk to a lot of the commercial people in the development space, and that's really, I mean, that has changed drastically. I mean, you've seen a huge pullback, almost to the tune of about 40% in that market, year over year to new construction, and there's going to be a big opportunity there where it is. Again, people smarter than me don't know that, so I would wager even to guess on that one. But at least from the single family space, again, it's it still seems like it's robust enough obviously for you to still continue to lend in it. But I guess I would ask the question of for these people that are doing that, what's really kind of the attractiveness of going with, and like what do you do different than the commercial space that makes it attractive for these people to utilize an outfit like yours versus again anyone else?
Yeah, I would say primarily it's speed and flexibility on draws is really important. Those two aspects, just specifically for our builders. Fix and flip, it's a little bit different, but getting into a property really quick and being able to reimburse them, because as opposed to fix and flip, you hire a contractor. And you pay the contractor, deposits essentially. Whether it's 20% up front and then 20% increments over the life of the project. With builders, they have subcontractors on payroll that need to be paid cash on Friday because they need to. They have living expenses that they need to cover for the following week, and so if they put in a draw request on Thursday, they need the money wired on Friday. And that's, to have 24-hour draw turnarounds is just so important for our builders. Their costs are come in large bulks. They're buying all the sticks for the framing at once. They're pouring the foundation over the course of one day. Sometimes they need to buy the materials on a Friday and get reimbursed for that so that they can pay their crew, so that their crew can come out on Monday. So just that flexibility, just that speed is so important. As soon as they get their permits and they've been greenlit, the lot is graded, the lot is shovel ready, they hit the ground running it's like a bat out of hell. It's like incredible how much how quickly they're moving. Sometimes they move quicker than our flippers. It's pretty unbelievable.
Yeah, no. So, and I guess that would be kind of a good position to kind of transition into where you see the market going forward. Because again, it's tough to kind of put your finger on the pulse of it, because my biggest qualm with what we're seeing right now is you see money getting more expensive. Granted, like we've said, and I think we all agree on that, it's getting to a point of equilibrium where I think it's healthy for everyone. It's 2.18, I think, is where like the 30-year fixed like bottomed out at in 2022, and it's just not sustainable. Again, there's a lot of pain when you talk about more than doubling your interest rate on the 30-year fixed, and with the monetary rate and how many basis points it went up. But again, I think it's getting into a little bit more of a healthy equilibrium. But the problem that I see is that you're still seeing basically the same price appreciation. I mean, it's tapered a bit, but you're still seeing this massive price appreciation. You're seeing some additional inventory and days on market start to inch up, and in some places just skyrocket, but you're not seeing a retraction in the underlying value curve to that, which is kind of what you need to see in this whole okay, things get more expensive, more of that, less demand. It's not necessarily happening to the degree that I thought it would. So again, kind of, no one has a crystal ball. Granted, 2022 seemed like it was a pretty good timing for y'all with your reposition, but what is kind of, your cautionary tale going forward of how you kind of think this is going to initially play out, and what are you doing to kind of position yourself in regard to your firm and investments to prepare for that?
Yeah, I think with that, I was having this talk with one of our investors the other day, because they're talking about when interest rates start going down, is that going to affect stuff? What's going to potentially happen? Or we'll get the questions like, hey, interest rates are still so high, like how can y'all continue to do what y'all do? And most of these questions are from wealthier individuals who made their wealth not in real estate, so they don't necessarily follow the track of real estate per se, but what I was telling them was my guess is probably as good as the person on TV talking's guess. Like, we really have no idea. We're just kind of going with the information we have now and making the best decisions possible with what we have now. So what we've seen with our houses is like what I've seen in Austin some and in DFW some is the houses sit a bit longer, but they still sell for the same price. But even right when I start thinking that, we'll have houses go off the market in like a week, 2 weeks. Like several of our new builds, Eric, have gone off like super quick. And I'm like, oh my gosh, like I thought this was going to sit, and they were getting offers before the house even hit the market, still in today's market. So I think for us, like, we make our best guess possible per se, and make the our actions as best as possible. We continue doing what we're doing, and Eric's really good at the underwriting and just mitigating the risk. So as long as we just like stay with the parameters we have, regardless what the market does, if we can be flexible and adjust with it, then we feel okay with what we're doing. And that's something that for our investors is an attractive mindset, because we're smaller, we're almost boutique-ish, which may not be the best way to scale, but we don't know what exactly we want to scale to per se, so that's okay right now. But I think they like the fact that we're boutique in a way, and we're like kind of like one with our borrowers essentially. But back to your question, just like making the best decision possible with the information that we have, and that's kind of how we see it. Mitigate the capital we have as best as possible, and that's always like our number one rule, regardless of the market.
Yeah. I think we will see a rate cut this year. That's my best guess. Inflation was like 9% in 2022, and now it's closer to 2. I think Jay Powell said we're close to hitting our target. Definitely a cooling off. It doesn't mean that prices are going down. They're just not accelerating at such a rapid rate. That's important to denote. Job growth is generally slowing down. So I think we will see a rate cut. I think it's already kind of priced in. I think the 30-year fixed is somewhere around it's below 6.5 in Texas. And so I think that's already being priced in. You see 10-year Treasury, going down. So I think that's already kind of been priced in. But all of this is, there's a big sentiment shift in that 5.5 to 7% on a 30-year fixed is the new normal. I think people gained a lot of equity, specifically in Texas over COVID, and that's only scaled back a little bit. So on the net, it's still been really positive. So people feel rich. With that being said, 42% of homes are owned free and clear. Home ownership rate is 60% for those, aged between 35 and 40. So we're not a renter nation. People are really mobile in Texas. We're seeing 55% of mortgages are less than 4% in Texas, which is actually one of the lowest across the country. So that means people are moving. People are getting out of their, 2 or 3% mortgages and getting a 5%, 6%, 7% mortgage. So there's net migratory patterns in Texas. People feel rich in Texas. High income jobs are up 6% above pre-pandemic. That's on a national level. I think it's like 20% in Dallas. So people are making money. So I think there's supply and demand principles that are helping us. There's people have like real wage increases. People own their homes free and clear, yet they're mobile. So I don't know if there's too much of a cautionary tale in the single family market in the DFW Metroplex. So that's very specific. I think there's generally a cautionary tale on a national side, but where we're operating, we're still seeing the data point to, lend aggressively. At the same time, we don't want to grow don't want to grow too fast and too aggressively like some of the lenders did over the course of COVID. Like Steven said, our most important objective in Parallel is preserving the capital that we have inside of our fund now. So whatever we can do to do that is paramount. Whether that's getting tighter on our underwriting. A big theme in private lending is fraud detection. Fraudulent bank statements, fraudulent agreements, fraudulent REO schedules. Just so figuring out a way to check for that. Large deposits going into accounts and then leaving. So it's not real liquidity. All that stuff we just have to remain tight on. And it's actually the beginning of Q3, so we're going like at the end of every quarter, we go through all of these processes and make sure that we're doing things in the correct way and try to see where the market is going. But right now, it's steady wins the course. While days on market are a little bit longer, existing inventory is a little bit stale, just anecdotally. But there's still heavy mobility and stable price appreciation. And I think we'll see a little bit of an uptick in appreciation over the course of the end of the year when we see that cut. But it's already kind of priced in, so steady wins the race.
Yeah, no, I definitely kind of like the answer that you gave me. It's, people, oftentimes like to, stand and say, hey, yes, I think this is what we're going to do. But, taking that a little bit more laid back approach to saying, we don't know, it's working now, so long as we don't get greedy, we should probably be fine. And I think, again, that general business and investing principle will, it is played people like Warren Buffett to the tune of hundreds of billions of dollars very well. It's like, understand what you do it well, have good systems, invest in what you know and understand, and don't try to, when a 15% return is good enough for everyone, don't chase the 2x multiple because you're going to get burned, or whatever that metric is for wherever you're at. But again, it's good to kind of talk to people that have that opinion, because I certainly do share it as well. To that effect. And then the last thing I'll kind of end on is you kind of hinted at it, but it's just how, at least post-COVID, one of the more interesting things that I've really looked at is just how we're seeing kind of a fracturing of the general markets of real estate in the US between and again, I don't have a better example between kind of the have and have nots, but you have these very ancillary markets that aren't necessarily extremely correlated to the broader sense of what's going on. Think about DFW Metroplex. Think about your, places in like Nashville, Tennessee, the Tampa, St. Pete area, Miami. These large, again, to the migratory patterns of COVID, and then the continuing eyes that are on these places that are friendly for, tax perspective, cost of living perspectives, continue to kind of just break from what, if you were to examine, everything in middle America and then examine like 4 or 5 different markets, you would see basically looking at 2 different countries, which again is not a great thing in my opinion. But it's, the world we live in, and you have to adjust your core competency and investment strategy accordingly. So just something, again, I find interesting to look at. So again, I really do appreciate both of y'all being on today. It was really interesting to, examine, what you have done kind of, again, developing a business right before basically the world ended. And then, how everyone has come out on the other side, because not everyone made it. And that's the sad part. My wife works in hospitality and, in hotels and hotel management. And it was crazy. I got family, from my own personal, perspective, got to see how bad it could be for people, but also on my perspective, how incredibly good it can be for people. Our business, ran gangbusters just like everyone in real estate did. Not that we're only focused on real estate, but it was just, again, a tale of 2 cities, if you will, when it comes to the markets and what happened. So if people want to learn more about what you have going on, or maybe specifically if they're in the DFW Metroplex and need money, what's the best way they can reach out to y'all at Parallel Lending?
I think just our website, right, Eric? Just through our website.
Yeah.
That's we have a social media that Alex runs, the Instagram, and he does a great job on Instagram, LinkedIn, all that stuff. Me and Eric are not that great at it. We've tried to improve, but yeah, I think our websites, what website is probably our most accurate way for borrowers, investors, whatever it may be. That's probably the best way to get in contact.
Yeah, parallellending.com, or just find us at Parallel Lending at any of the social medias.
All right, fantastic. Well, again, I do appreciate y'all's time today. The most valuable asset we all have is our time, because no matter how well we invest, we can't make any more of it. Thank you very much for both being on. My name is Alex Perny. As always, this is the Alternative Investing Advantage podcast, and thanks for joining with us.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.